Over the past 100 years, the stock market has crashed 9 noticeable times. Remember guys, that a crash is anything that falls below 20%. So generally speaking, a stock market crash occurs around every 10 years if you do the maths. And I do hate to say it, but it has been 10 years since our last stock market crash, which started in 2007 and ended in the beginning of 2009. Now, I've listened to a lot of experts say that there is a decent chance that a stock market crash could occur within the next couple of years. Here is what some of the experts on the situation are saying. First, let's see what Ray Dalio has to say on a stock market crash. A lot of investors think that Ray Dalio is the best at seeing where we are in the market cycle, so he's not a bad person to start with. So, Ray Dalio basically thinks that we are in a similar situation to that of 1937. And people say that if you don't learn from history, you are doomed to repeat it. And Ray Dalio is certainly someone who has learned from history. So basically what happened in 1937 was there was a bear market and stocks fell for around 10 years. If Ray Dalio were to be 100% correct, then stocks would fall by up to 40% over the next 10 years. And here is his reasoning behind it. Okay, he said this. He said debt cycles are tied to politics. When times are tough, populists take charge. We saw that in the US with President Donald Trump's election. Brexit is an example of populism, as is Italy and several other countries. These are periods that are prone to international conflicts, including trade wars. And these can be signals that we are near the end of the economic cycle. But of course, we don't necessarily know if things will play out this way. I personally have followed Ray Dalio for a while now, and he has talked about the chances of a stock market crash being very high for a number of years, and the only thing that we have seen is stocks continue to rise. So take any expert's advice with a grain of salt. Anyway, let's move on to another expert by the name of Paul Tudor Jones. You might have heard of him before. He is well known for betting on interest rates and currencies and stock markets. He said, "We have the strongest economy in 40 years at full employment. The mood is euphoric, but it is unsustainable and comes with costs such as bubbles in stocks and credit." But for the year of 2019, Paul Tudor Jones is actually bullish for US stocks. He said this, "I think this year we're going to continue to have US exceptionalism and US outperformance." He says the S&P 500 will outperform its peers. It will outperform emerging markets. And so far he has been right, as US stocks have performed fantastically over the past couple of months in 2019. So essentially, you've got a few investors who think things will rise in the short term, but they aren't bullish for, let's just say, at least the medium term. Let's answer the next question, which is, if a stock market crash were to occur, how big could this crash be? So to do this, I want to go through the previous market crashes in history, see how big they were, so we can get a range for potentially how big this next one could be. So I'm going to start by taking you way back to the Great Depression in 1929. After this depression period was over, people were put off the stock markets for a long period of time. And this crash was absolutely massive. It crashed by 86.1%. Imagine the prices of your investments going down by that much. Okay, let's go through these crashes a bit quicker. So, 1946, it crashed 29.6%. 1961, 28%. 1968, 36.1%. 1973, 48%. 1980, 27.8%, 1987, 33.5%, 2000, the technology crash, 49.1%, and the most recent crash was 56.4%. That's pretty high. So if we go by what history tells us, stocks could crash anywhere between 86.1% and 27%. But I will say this, I personally don't see stocks crashing by 86% or anything like that for the US market. And the reason is because we're in a different time to that 100 years ago when stocks crashed by that much. Realistically, I would personally say that I could only really see stocks crash by 50% at the maximum. And if we are talking about the US market, let's be clear here. Because right now, the US market's PE ratio is it's 22. If stocks were to crash by 50%, the market's PE would be 11. So just imagine stocks on average having a PE ratio below 11 in the best market in the world, the USA. The stock market in which people trust, the stock market with the most information, the stock market in the most capitalist country in the world. I do struggle to see a PE ratio that is anywhere below 11 in the future. And that's why I don't think stocks would crash by anything more than 50% if they did crash. Right, now I want to move on to the greatest investor in the world, Warren Buffett, and what he thinks about market crashes and what he's currently doing at the moment with regards to stocks. So essentially with Buffett, he does not try and predict stock market crashes or anything like that. He does not time the market, and he says he never really has an opinion of the market, because Warren Buffett knows that at least over the short term with regards to stocks, no one knows what's going to happen. But there is one thing that Warren Buffett does focus on, and that is on individual businesses. Buffett says this, and I think this is a quote that we should all note down. If we're right about a business, if we think a business is attractive, it would be very foolish for us not to take action on that because we thought something about what the market was going to do. If you're right about the business, you'll end up doing fine. This is so key. So essentially what he's saying is he's not worried about the stock market with regards to the short term, whether it will crash, whether it will go up, but it doesn't bother him because he is a long-term business owner, in strong, good quality businesses at attractive prices. Warren Buffett knows if he buys this, he will make a great long-term return, no matter what stocks as a whole do over the short term. And you know, if you want to sleep at night, well, you need to make sure that most of your portfolio is in solid, good quality businesses that are going to keep generating money whether you're in a recession or whether you're in a bull market, no matter what market conditions. And this is why when people ask me, how do you invest in times like these? I say a couple of things. First thing is make sure that you are mainly buying stocks that are solid, good quality businesses that are selling at fair prices. You can't go wrong with value investments. And this is the style of investing that Warren Buffett uses to make him rich. It's got him through plenty of recessions. Most of the recessions that we just talked about earlier on in the video, Buffett has been through. The second thing that you can do is buy into stocks that are paying reliable dividends. Stocks such as dividend aristocrats, because these types of stocks actually beat the market over the long term and do very well compared to the market in tough market conditions. These are the types of stocks you would prefer to own in a recession. Stocks that are just chucking off that cash flow to shareholders. The third thing that you can do, which is what Warren Buffett does a lot of, and that is have a certain portion of your portfolio in cash. And this way, when stocks do crash, you now have money on the sideline that has kept its value. And you can now buy stocks when they are cheap. And I believe, Buffett, he currently has 40% of his portfolio in cash at the moment. Now, I wouldn't want nearly anywhere as much as that, but some portion of cash is important. Fourth thing that you can do is diversify. Diversify across different sectors in the economy and diversify into other economies as well. like the Chinese economy, the English economy, the Australian one. This way, you're not 100% reliant on just one economy for your net worth. For example, I recently bought a stock called Alibaba. And not only do I like the company and the price that it was going for, the other reason why I bought it was to diversify my net worth into another economy, which is China, which is actually growing at really strong rates. But hey, at the end of the day, I'm still buying stocks. So is Warren Buffett, because stocks will give you a better return than bonds or having your money in cash. And that is the reason why I'm not waiting on the sidelines, waiting for a crash to happen before I start owning businesses. I want to own businesses now, and I want to continually be buying businesses and increasing my portfolio into businesses. Being a business owner is the thing that's going to drive your net worth up the most. Real estate is another good investment, another good way of investing your money. But yeah, when you compare stocks to the likes of bonds or cash, stocks are going to win. And that is the reason why I'm not waiting on the sidelines, because owning businesses will always deliver a better return than holding cash or buying bonds. I'm still buying. Let me know what you're doing in the comment section. Are you buying stocks or are you waiting for the crash? Yeah, let me know. I'm keen to know what the people think. And yeah, don't get me wrong. I do have a certain portion of my portfolio in cash at the moment, but it's not near as high as Warren Buffett, 40% of my portfolio. But at the end of the day, even though there might be a stock market crash coming, I'm still going to keep buying stocks, still going to keep being a business owner. Thank you guys. I'll see you soon.